Investors have generally benefited from a positive start to the year in global stock markets, as economists have become less worried about the risk of a recession this year. Companies continue to generate reasonable profits, and there's a continued narrative around the potentially transformative effect of artificial intelligence. Looking around the world, Japan was the best performing major market, up 18% in the first quarter. There's growing hope that Japan is now escaping from deflation, having seen nearly 30 years of weak economic growth, falling prices for goods and services, and stagnant wages. Moreover, weakness in the Japanese currency, the yen, benefited Japanese exporters. US equities also fared well, up over 10%, led by the big tech stocks like Nvidia and Facebook's parent company Meta. These are often referred to as the Magnificent Seven, and many of them are benefiting from the AI theme. Elsewhere in the world, most equity markets rose, but by more moderate amounts. For example, UK equities posted a 4% return in the first quarter. Not as good as Japan or the US, but still an attractive return for only a 3-month period. However, whilst equities rose, bonds underperformed in most regions. You may remember that inflation fell in many countries in the second half of last year, sparking hopes that central banks will soon be able to cut interest rates. But as economic growth remains okay and job markets look robust, particularly in the US, so investors have started to reassess when central banks will start lowering rates and by how much. The most important change has come in the US, where markets have gone from expecting 6 rate cuts this year from the Federal Reserve to now questioning whether they'll manage to cut twice. This is a big change, and it's undermining bonds as higher yields on cash make lower bond yields look less attractive. In recent months, we've been overweight equities and underweight bonds, so that's helped add to performance in portfolios. We're happy with the position for now as we closely watch central bankers for clues as to whether they'll cut interest rates later this year. We're also paying close attention to regional variations, with growth looking stronger in the US than Europe and China. That suggests that the US dollar could remain strong. It offers a good protection for portfolios against the risk that central banks don't cut rates. In conclusion, current market conditions appear to be favourable for potential returns. While there are always risks involved in investing, there's a good chance that economic growth continues to support stocks. Additionally, whilst we remain negative on bonds today, ultimately this fall in bond prices creates the potential for higher bond returns at some point in the future. Finally, it's important to remember that investing always carries some level of risk. Our goal is to protect your investments from economic ups and downs while taking advantage of opportunities when they come up. We're here to help you navigate the investment market. Thanks for watching.